Does it still make sense to be passively investing into commercial real estate in April of 2020? Welcome back to Fear-Free Passive Investing, where we help busy professionals navigate the world of passive commercial real estate investing. My name is Lucas Miller, and I am passionate about helping people grow true passive wealth in real estate. I hope you're all doing really well and your quarantine haircuts are going a little bit better than mine. But today's topic is one that's been on the minds of a lot of people, and I know it's something we got to address today. It's one of those things that everyone's been talking about and we really got to figure it out. And that's, should you be investing passively into commercial real estate right now as of April 13th when I'm filming this, 2020? Now, this is a really hard question to answer, and obviously my advice is going to be subject to change. Right now, it's, like I said, April of 2020. They are telling us that the lockdowns that we're currently quarantining ourselves in are going to be lifted in like a month or so. And so that's really driving how I'm going to be answering this question. So my advice is subject to change. It is based on just what I'm seeing right now. Let's call it a snapshot. Now, my experience for the last few years of being a multifamily owner, operator, buyer, I've never seen anything like this. Basically, people have been scared away from buying multifamily right now, which could be a good thing and it could be a bad thing. Almost overnight, we went from an extreme seller's market to sort of a quasi-moderate buyer's market. Now, we're not seeing any sort of extreme discounts right now. In fact, we're not seeing a lot of anything right now. A lot of the brokers that sell and broker these big multifamily transactions, which is particularly what I'm involved in, but across the board, a lot of these commercial real estate listings have been pulled off the market. The only people that are really selling right now are people that have to sell. And if you think about it, that makes sense. If you're not in a position where you have to sell, you're gonna kind of pull your listing off the market, maybe see how the next couple months goes, and go from there. Who knows where we're gonna be at? So if I was selling a building and I didn't have to sell the building, I would definitely pull it off the market. Now, it's kind of funny. I've seen some operators that have said, oh, there's blood in the water. We're going for it. We're going to get these huge discounts. I got to raise a ton of money because we're going to buy properties 20% off of what we could have bought them 2 months ago. I think that's ridiculous right now. There's nobody willing to make that sale. With the caveat is, like, obviously, unless they have to sell, they might make that decision. But even if they have to sell, or maybe they just want to sell, 20% of a discount right now is crazy. I'm not seeing that. I could be wrong, but I'm just not seeing it. But that being said, there has been significant pullback from multifamily buyers. I think a lot of people who haven't been through a downturn or maybe aren't quite as educated in this are pulling back, and that's creating some opportunities for people. This sort of dynamic does create some sort of a supply and demand issue where if there is a building that needs to be sold, there's going to be less competition, which is great. And that coupled with the debt portion, which if you haven't heard my latest Fear-Free Passive Investing Friday 5, where I talk about lenders kind of pulling back, I'll link that here in the YouTube card so you can go listen to that. But basically, lenders are pulling back a little bit, commercial lenders, and they're changing up the terms a little bit. So that's changing pricing on these multifamily buildings, and that's going to obviously have an impact on what we can buy things for and what sellers are going to have to sell things. With that, what we're seeing right now is deals that have been under contract since before this coronavirus stuff happened are now going back and renegotiating their terms based on either debt issues like we were just talking about, or they just want to have some sort of price reduction, or they're trying to include new verbiage in the contract, which we'll get to in just a second. But most of what we're seeing that has been under contract is now not closing based on the original terms. They're going back and renegotiating. Now, that verbiage that I talked about being inserted into contracts is something called force majeure, and it basically means that because of some unforeseeable circumstance that we are no longer able to fulfill this contract and we need to renegotiate basically or get out of it. You're seeing a lot of buyers of commercial buildings across the board going back and reinserting that language if it wasn't in there already. And that's what they're going off of. And this is something that's really common for the commercial folks, like the office buildings, the hotels, folks like that. That's usually in their contract, especially if they're what's called a creditworthy tenant, or a tenant that is a national buyer or renter of space. Think like Walgreens or Hertz Rent-A-Car, or any number of those large, big renters that need space. Probably already have that in there. As of right now, again, in April of 2020, the biggest hurdle is really that debt piece. And if you didn't go watch that video about commercial lenders pulling back, I really encourage you to go listen to that, because that's going to explain a lot of what I'm dealing with personally right now. I had a deal that was under contract in February, early February, and we're still going through things, we're renegotiating things, and we're going back and forth. But our biggest problem right now is securing that debt piece. Not the equity, the debt piece, the loan. And so even with rates at historical lows, the Fed across the board has lowered its rates because of so many commercial lenders backing out of the market. Some of them are out of money, frankly, and some of them couldn't sell loans, so they don't have money, and some of them are just being cautious. That's creating a supply and demand issue with Freddie and Fannie for the multifamily loan aspect. This agency debt, now everybody is flooding to that, and not only are they backed up big time, like it's taking a long time to do anything with them, their spreads are getting bigger and bigger because more people are going to them, and obviously they have the supply and it is in demand, so they're going to be charging accordingly. So that is basically the snapshot of what I am seeing right now in the commercial real estate investing sector. But with a quick question of the day for you, has any of this coronavirus situation changed how you're looking at investing in real estate, whether you're investing passively, whether you're an active investor, whether you do residential or commercial? Let me know down in the comments, what has this changed for you and how are you adapting your business to it? And while you're down there, go ahead and hit that like button. It really helps me know if I'm on the right track or not with these videos, and it lets me know that I'm delivering value to you, and so I can keep creating these videos. Let's get to the meat of today's topic, which is, should you still be passively investing in commercial real estate in April of 2020? Now, I'm going to start by saying that there's going to be some huge opportunities for real estate investors in the coming months, probably 4 to 6 months. I've been waiting personally almost a decade to take advantage of some sort of downturn to be in a buyer's market. However, and it's a big however, now is the time to really start stress testing your investments and making sure your operators are stress testing their investments as well. And that is mainly because with the increased interest rates and various terms, it's really going to put a lot of pressure on proceeds, because that debt service coverage ratio, which is the ratio of how much money you're bringing in to how much it's costing you to pay down that debt, that ratio is going to constrain what you can actually pay out in your multifamily model or your office model or whatever it is. That debt service coverage ratio is really going to hamper what you can do and what you can produce as far as proceeds. Caveat that also with some of the lenders that we've been hearing lately, and I mean like today I got this, is that some lenders are now putting in provisions that you can't even send out proceeds until all of this coronavirus stuff is figured out and everyone knows a little bit more where they're at. So that's a huge thing. I'm gonna have to do another separate video on that just because I don't really know anything about that. I was just told that. So we're gonna have to go down that road and do a little bit more research. So let's talk a little bit more. When the loan proceeds go down, how much they're willing to lend you, when that goes down, equity is gonna have to be increased, meaning we're gonna have to put up more money because we can't get as much leverage. Now, typically in this situation, this causes returns to go down, and because you have to put up more money, right? You have to increase the pie that you're cutting up. And so there's just going to be less to go around. And obviously that equity's got to come from somewhere. If I as an operator are still trying to advertise the same returns to my investors that I have been for a while, something's got to give, right? If I have to pay more equity, I'm going to be expecting a lower price for that property, which then causes cap rates to expand and values are going to go down. This gets back to stress testing that deal, and you really hope that that multifamily sponsor or that healthcare or that self-storage sponsor, whatever that is, you hope that they accounted for this correctly when they did their original modeling back before the purchase. Now, the good news, as long as you understand this relationship between equity, debt, cap rates, debt service coverage ratio, all of this stuff, and you have conservative underwriting, there's gonna be some really great deals. And I mean that in a way that I've never experienced before. So I am very excited for that. Cautiously optimistic that we're actually gonna be going into a buyer's market. There's some people saying that this is gonna rebound and it's just gonna go even higher because people are looking for a safe place to put their money. And especially multifamily is going to be that safe haven for a lot of people. So we'll see if that actually happens. But either way, sellers are going to have to recognize that their buildings just aren't worth as much money right now. And buyers are going to have to make sure that they are accounting for all the craziness that's going on with the debt side right now. And before we get too much further, I want to address one giant myth that I hear constantly, and I actually believed it for a long time too. And that is you have to buy in a down market and ride the wave and sell in an up market. I think a lot of investors think that, oh, if I had just bought a bunch of houses in 2009 and sold them last year, I would be sitting on millions of dollars. And that's very true, right? You could have done that. But there's also people that are still making money in down markets. There's people who made money in 2008. The difference is you just got to recognize what's happening and historically how that fits into the picture with where you're at right now at this point in time. So I hope this has been helpful for you. Overall, if I had to sum it up in just a couple phrases, we obviously went from a seller's market to potentially a buyer's market. I don't even want to call it that. We're somewhere in the middle. We're in the gray area. I think in 4 to 6 months, we're going to know a whole lot more with where we're at right now. But with everything that's going on with the freeze on evictions, with the stimulus, with the lockdowns in place, things like that, that is really like you have to have a crystal ball to know where we're going to be. So maybe we'll do another one of these videos in May and see where we're at. But April, right now, I haven't seen anything to make me want to stop buying real estate. But it's definitely changing how I'm buying real estate, that's for sure. And as a passive investor, I don't think you should be worried about that necessarily if you're in it for the long run. If you're in it for a quick buck, you're gonna have trouble, frankly, because just like this, just like the stock market, you don't want to get in and try and time the market. You want time in the market. Same thing with passive commercial real estate investing. If you have a long enough runway and your sponsor is responsible enough to understand conservative underwriting, you're going to be fine. So with that, let me know what you think, where we at in the market. Let me know down in the comments. I'm happy to start a conversation with you there. But if you have any other questions, please let me know, reach out. If you liked what I had to offer you today, go ahead and hit that like button. I really appreciate that. Leave a comment down below and check out some of the other videos we have going where we put out weekly videos constantly. I'm trying to push out as much content as I can with 2 little kids, but it's what I can do. So anyway, thanks for watching, and I look forward to talking with you again soon. Bye.